Hi, I'm Adrian Helfert, CIO of Multi-Asset and Alternatives for Westwood. Thanks for joining us to talk markets and outlook. The market was certainly looking scary for the last couple of months going into Halloween. The S&P 500 bottomed out around the end of October with almost a 10% drawdown from late July. Thankfully, it's risen about 6% since then. At that same time, the 10-year U.S. Treasury yield touched 5% at an elevated level and then fell back to 4.5% pretty quickly. Primarily, these moves seem to be on the back of the notion that we are at peak interest rates from the Federal Reserve, peak financial tightening. Not even a Fed pause, but the end of the rate hike cycle that has been impacting markets so heavily. And of course, a 5% 10-year Treasury yield must have seemed just too much to hold just yet. We'll see if that can hold its notion going forward. Since Halloween, energy is the only sector that's in the red. Technology and especially the mega cap tech firms are driving returns since then. Of that 6%, the S&P 500 is up. 7 mega cap firms, the so-called Magnificent Seven, are around 40% of the contribution of those returns. For the year, that metric is surprisingly large. Those 7 firms are over 100% of the returns of the S&P 500. The not so magnificent 493 are actually down on the year. Technological advancements like artificial intelligence are helping drive this dynamic, as well as the Fed rate hiking cycle that we're currently going through. This makes value-oriented companies, certainly those with dividends, a little less attractive in the near term. We feel that makes a great entry point for equity selection, where valuations for many of these firms are actually underappreciated and now cheap on measures of price to equity and price to cash flow. And the Fed is nearing a peak Fed funds interest rate. They're going to stop hiking interest rates. And if and when the Federal Reserve drops rates, valuations could move higher and dividends will be more attractive for investors than they have in a rate hiking cycle. In our multi-asset income funds, we recently moved from neutral to positive on equity to capture this dynamic and this upside. In credit spreads have continued to outperform the equity market. For the year, if we just look at high yield bond yield spreads, that's the compensation for default risk. That means an increase of yield over the risk-free rate. They're lower on the year by around 0.075% to around 4% of that yield spread over treasuries. That's not much historical compensation for default risk, but we think at least half of that is due to the outperformance of the asset class to equities. Effectively, people really like those 9% all-in yields. That's what high yield bonds are now, around 9%. Investment grade are around 6%. That makes things look awfully attractive relative to a less than sanguine equity outlook if you have that. There's been a lot of talk about the 2024 rate expectations and whether we're going to see further rate cuts there. Right now, the market prices those in, and it stands at around 3, just a little less than priced rate cuts for the year right now. Actually, that's hard to imagine, just given the rate hike cycle that we are going through or have been through. That said, if the economic situation warrants cuts, it would be unusual for the Fed to cut that slowly. It's possible that this is a bimodal distribution. That means that there is a low probability that we are seeing more like 8 to 10 cuts, a reactive Fed to really poor economic situation that happens, and a higher probability that we see no cuts. We see what the Fed has already telegraphed very well of higher for longer. That's what we think we are seeing. That's an underappreciated risk, we think, that is impacting investors that are sitting in cash and waiting for the possibility of some movement. Either way, an underappreciated risk for investors sitting in cash and waiting is the reinvestment risk. That 3-month CD may be 5% right now, but it's likely to drop over the next year. Investors should consider locking in some of the higher interest rates available, longer in maturities, as well as capturing some of that valuation upside risk in securities that we think is there as well by extending out of cash where necessary. On the economy, the data is surprising to the upside still, insinuating that we are likely to see a soft landing or a no landing. Although that data is slowing some. Housing data is finally starting to underwhelm a little bit. And no real surprise with the rate of a new mortgage way above the average rate that homeowners have financed their homes. It's hard to move basically when your house that you're moving into is the same value, but your mortgage bill is double. That's what happens when mortgage rates rise significantly. Inflation is dropping, and the simple question is, can it drop fast enough to keep the Fed at bay from hiking rates further? We'll find out more going into year end on this question, but we think likely that yes, it will continue dropping enough to keep the Fed at bay from hiking further. We're pretty much done on third quarter earnings season. While we emerged out from the negative year-on-year earnings trend this quarter, meaning this quarter we now have positive earnings growth on a year-on-year basis. That's something we haven't seen in 3 quarters. The 2024 guidance from many companies is either being reduced with less uncertainty, or is just simply lackluster for the market expectations. That's caused some of the consternation we saw in the markets over the first 2 weeks just prior to Halloween. We think we're seeing this as a signal maybe of the higher capital costs, the restrictive financial conditions that are finally impacting some areas of the real economy. Higher interest rates from the Fed will have an impact, and this is an area where we can see an impact. Somewhat potential for lower spending, higher capital costs for companies that may reduce the amount of projects that they're involved in because the ROE on those projects, the return on equity, is simply not as high. We're nearing the end of the year, and the narrative is shifting with us as well to 2024 expectations. Our outlooks, the expectations for market pricing. We are revisiting our scenarios for 2024 outlook numbers, and we'll have that shortly along with an updated capital markets outlook. And always, we would be happy to discuss that with you. Thank you so much for listening. I won't be doing this again for another month. So until then, have a great Thanksgiving.